But I have to admit, Causeway has a value emphasis, so I am talking my own book. But what we've seen at some extremes, and that usually means end of cycle. For example, the value versus the growth indices in the world index trade at extreme gap. The value index trades at 12 times next year's earnings, and the growth index at a whopping 20 times. And all of that's happening when volumes or volatility has been falling, especially in the U.S. market. Meanwhile, the returns have been rising, and those aren't typically, that's not a sustainable situation. So we tell our clients, make sure you have value, make sure you have that diversification. Don't put all your eggs in one growth basket.
Though, I mean, hasn't that been the argument, Sarah, for pretty much this entire bull market over the last 10 years? And yet, the valuations continue to rise for the growth names. Technology is the leading group so far this year. Why would anything change right now?
It's just when no one thinks it will change that it does. But what's different now is that the Fed has actually shrunk its balance sheet by $500 billion from its peak. And global monetary growth that infused this tremendous growth hunger. Investors had to get their hands on growth stocks. They'd do anything, so it seems, even when there's no sign of earnings or cash flow. Now we're in a situation where monetary growth is slowing, and as a result, there may be much more interest in the stock that trades at 12 times earnings rather than 20, even if its growth isn't nearly as rapid. And there's so many stocks out there like that. You've made reference to banks. In the industrials area, there are plenty across the board, and not just cyclical stocks, in defensive areas as well.
Sarah, a lot of your picks and some of your comments so far suggest a big preference for the lower valuations in Europe and around the rest of the world compared to the US. But one could have made that argument a year ago, 2 years ago, 3 years ago, and you would have missed out on the US's outperformance. What makes you confident that now is the time to shift into those regions like Europe?
Well, this isn't necessarily an argument to invest only abroad, even though stocks are generally cheaper offshore than they are in the U.S., but rather to emphasize those shorter duration stocks, the stocks delivering income now, that deliver cash flow now. One of the stocks we've talked to clients about is Volkswagen in Germany. Here's a company that it was in a race against time, but believe it or not, what's extraordinary, went into the Dieselgate crisis with net cash and today has 25 billion euros of net cash and is generating increasing amounts of free cash flow through cash conversion. And why we like that is because investors, you're going to get paid now. You don't have to wait 10 years or pay 10 times sales for that luxury. So there's a sort of tangibility, this short duration, less interest rate sensitivity to value stocks that's meaningful in this environment as liquidity is less abundant.